Imagine having, like, your best financial year ever.
Oh, the dream scenario.
Right. Your profits are breaking records, your cash reserves are just overflowing, stock is booming, your core business is essentially, well, it's printing money.
Right.
Now imagine taking all that momentum, all that pristine financial health, and just voluntarily swallowing a massive multi-billion-dollar struggling company. A company that immediately tanks your quarterly profits by 57%.
Yeah, it sounds crazy.
You essentially blow up your own victory lap to take on this really messy, highly public renovation project.
It is the ultimate corporate paradox, honestly. I mean, most management teams in that exact position would just play it safe. They'd buy back some stock, pay out a nice dividend, and just coast.
Yeah, take the easy win.
Exactly. Choosing to invite chaos into a perfectly functioning machine, it requires a level of aggression that you just rarely see in legacy retail.
Well, welcome to the deep dive. Today, we are looking at exactly that kind of chaos for you. We've got our hands on a highly revealing corporate document. It's the DIC Tests Sporting Goods Q4 and full year 2025 earnings report.
Yeah, which just dropped on March 12, 2026.
Right. And the story hidden in these numbers is just, it's wild.
The stakes here are fascinating, especially for anyone listening who's interested in business strategy. We are going to explore how a company balances the incredibly reliable, cash-generating engine of its core brand with this really high-risk, high-reward turnaround play, a play that essentially aims to redefine its entire place in global culture.
Okay, let's unpack this, because to understand why they took on such a massive risk, we really have to look at the war chest they built to fund it.
Right, the foundation.
Yeah, let's start with the core engine itself, the traditional DIC Co-op sporting goods business. The numbers from 2025 are, frankly, staggering for a standalone physical retailer.
Oh, completely.
We're talking about delivering a 4.5% comparable sales growth for the full year. And the detail that really stands out to me in the report is that this growth was driven by both an increase in average ticket and an increase in transactions.
Which is, it's basically the hardest thing to achieve in physical retail right now.
Why is that?
Well, often when you see retail sales go up in today's economy, it's a bit of a mirage. It's just inflation. So prices went up, total revenue went up, but foot traffic actually declined.
Ah, right. People are buying less but paying more.
Exactly. But an increase in transactions. That means physical bodies are walking through the front doors. It means genuine underlying consumer demand, not just, price hikes padding the stats.
And the profitability proves it. I mean, they hit a non-GAAP operating margin of over 11%.
That's massive.
And a non-GAAP earnings per diluted share of $14.58 just for the standalone DIC business.
Wow.
The board even authorized a 3% dividend increase, which brings it to an annualized $5 per share. So the core business is an absolute fortress right now.
It really is.
But here's where management completely abandons the traditional playbook. Because even within their core brand, they are tearing up the floorboards.
What's fascinating here is that DICKS is aggressively choosing to disrupt itself before someone else does.
Right.
Instead of just rolling out the exact same, highly profitable big box stores they've built for decades, they're fundamentally changing the physical footprint of their retail presence. In 2025 alone, they opened 16 House of Sport locations and 15 DICK's Field House locations.
And the 2026 guidance shows they are stepping on the gas even harder. They plan to open 14 more House of Sport locations and 22 more Field House locations this year.
It's a massive rollout.
It is, but I have to play the skeptic here for a second.
Sure.
If I am an investor, right, and I'm looking at this massive, highly profitable fleet of traditional big box stores, why mess with the formula?
It's a fair question.
It's like a championship sports team deciding to completely rebuild their stadium right after winning the title. Why pour hundreds of millions of dollars in capital expenditures into these massive experiential megastores when the basic racks of T-shirts and treadmills are clearly still generating massive returns?
Because those basic racks of T-shirts and treadmills have a terrifying, invisible competitor, which is your smartphone.
Oh.
For you listening, it's about understanding when to pivot from a position of strength, rather than waiting for technological disruption to just, force your hand.
Yeah.
The traditional big box retail model is inherently vulnerable to e-commerce. You can buy a dumbbell, a kayak, or a pair of running shorts with one click from your couch. DICKS understands that to physically pull you out of your house and into a 100,000 square foot building,
Yeah.
that building has to offer a dopamine hit the internet cannot provide.
Right, right. Like, I can buy a baseball bat on Amazon, but I can't test my swing against a 70-mile-per-hour fastball on Amazon.
Precisely. The House of Sport concept is engineered entirely around action. It features climbing walls, multi-sport simulators, batting cages.
It's like a theme park.
It really is. They even have outdoor turf fields that convert to ice rinks in the winter.
That's insane.
It shifts the psychology of the consumer
Yeah.
from, I need to go run an errand to, I want to go spend an afternoon.
Wow. Yeah.
So by making these massive capital expenditures now, while they have that immense cash flow from their $14.58 EPS core business, they are basically building a structural moat against digital competitors.
Okay, so the core DI6 business is this incredibly robust cash-generating fortress that is actively future-proofing itself.
Exactly.
And honestly, you need a fortress like that if you are going to take on a complex, messy reclamation project.
You really do.
Because the profits from that core engine are exactly what gave them the leverage to swallow the $2.5 billion elephant in the room.
Ah, yes. September 8, 2025. The day the landscape of retail shifted.
DI6 Sporting Goods officially acquired Foot Locker. And the financial mechanics of this deal are wild. The total price tag was $2.5 billion. But they didn't just write a massive check.
No, they did.
The deal was structured with $2.1 billion in shares, meaning DICS issued 9.6 million brand new shares of their own stock, plus $223 million in cash and about $111 million from pre-existing equity they already held in Foot Locker.
They bought an iconic cultural brand, but, they bought one that had been severely struggling to find its footing.
Yeah, Foot Locker was in a tough spot.
Absolutely. Foot Locker had been heavily reliant on a single supplier for decades, which is Nike. And as Nike shifted towards selling directly to consumers through their own apps, Foot Locker's mall-based stores saw foot traffic and relevance just plummet.
Which brings us to the immediate brutal financial drag this acquisition caused, which is impossible to hide in this earnings report.
It's right there in the numbers.
Hold on, because earlier we praised their non-GAAP numbers for the core business, but when the report discusses the consolidated company with Foot Locker included, it shifts to GAAP numbers. And those GAAP numbers show net income in Q4 plummeting 57%, down to $128 million compared to the prior year. So why switch the measuring stick?
Because non-GAAP lets a company filter out one-time painful expenses. It's a way for management to say, hey, if you ignore the massive emergency plumbing bill we had to pay this month, our household budget is doing great.
Oh, I see.
But GAAP generally accepted accounting principles that forces you to put absolutely everything on the table. It shows the raw, bleeding reality of the corporate bank account.
And the reality of buying Foot Locker was incredibly expensive.
Yeah.
And the performance of the underlying asset wasn't exactly helping either. If we look at Foot Locker's pro forma comparable sales, meaning how those specific stores performed in Q4, as if DICs had owned them the entire year, they were actually down 3.4%.
Right.
They bought a shrinking asset.
If we connect this to the bigger picture, what we're looking at is a classic, deeply painful turnaround play. Executive Chairman Ed Stack used a brilliant, very deliberate phrase in the report. He called their current efforts a clean out of the garage.
I love that quote. It's so vivid. But what does cleaning out a $2.5 billion garage actually look like in practice?
Well, it looks like liquidating decades of operational bloat. When you buy a massive legacy retailer like Foot Locker, you aren't just buying their globally recognized logo.
No, right. You get the baggage.
You are buying their bad inventory, their terrible 20-year store leases in dying malls, and their totally outdated supply chain infrastructure. So DICS is currently executing a massive review of unproductive assets. They're closing underperforming stores, like the 7 WSS locations they immediately shuttered.
Right.
But the most painful part is optimizing the inventory.
The report lays out just how painful that is. They expect these clean-out actions to result in massive pre-tax charges between $500 and $750 million.
It's a huge hit.
And $390 million of that has already been recorded in 2025. That includes a staggering $217.9 million charge just to write down and liquidate Foot Locker inventory.
To understand why that number is so huge, you really have to think about the physical reality of retail. Writing down inventory isn't just a paper loss on a spreadsheet. It is a physical logistics nightmare.
Because the stuff actually exists.
Yes, you have hundreds of thousands of pairs of unsellable shoes sitting in warehouses and back rooms. They are taking up physical space, they are costing you monthly rent, and they are tying up cash. You have to aggressively mark them down, sell them at a massive loss, or literally pay to haul them away, just to physically make room on the shelves for the new strategy.
It's like paying for the dumpster in the driveway.
Exactly.
If you buy a historic fixer-upper house, you have to rip out the rotten drywall and pay thousands of dollars just to haul away the previous owner's debris before you can even think about picking out paint colors.
And that dumpster is exactly why the Q4 Jap net income dropped 57%. They absorbed the shock all at once.
Wait, a 57% drop is a massive shock, though. I have to challenge the core wisdom of this deal.
Go for it.
Yeah. They just diluted their own shareholders by issuing almost 10 million new shares. They sliced the corporate pie into 9.6 million more pieces, making every existing share slightly less valuable to buy a company that is currently shrinking by 3.4%. And now they are facing up to a $750 million clean-out bill. At what point does management look at the rotten drywall and the massive dumpster bill and admit they accidentally bought a lemon of a house?
That is the multi-billion-dollar question that literally every Wall Street analyst is asking right now.
I bet.
But from an operational standpoint, ripping out the drywall is just step one. The negative comp sales and the massive write-downs are the final symptoms of Foot Locker's old operating model, not DICK's new one.
Okay, so it's a clearing of the slate.
Right. Management is intentionally absorbing all this financial pain, immediately taking the massive gap hit in 2025 so they can reset the baseline to zero. Once the garage is clean, you have to actually live in the house and make it profitable.
Yeah.
And that brings us directly to the combined company's incredibly aggressive vision for 2026.
Let's look at that 2026 playbook, because the forward-looking guidance they provided is bold.
Very bold.
For 2026, DICK's expects consolidated non-GAAP earnings per diluted share to be between $13.50 and $14.50. The core DI6 business, that reliable engine we talked about earlier, is expected to grow comps by 2.0 to 4.0%.
Which is healthy.
But the headline here, the real shocker, is their expectation for the Foot Locker business. After shrinking by 3.4% in Q4, they are guiding for Foot Locker to return to positive pro forma comp growth of 1.0 to 3.0% for the full year 2026.
This raises an important question. How exactly do they plan to force that inflection point?
Right.
Because you can't just clean the garage, empty the dumpster, and expect the house to suddenly double in value.
Exactly. Just because you threw away the bad inventory doesn't mean customers will magically walk back into the stores.
You have to give them a reason. In the report, CEO Lauren Hobart and Executive Chairman Ed Stack point to a highly strategic lever they are pulling called the Fast Break Initiative.
Fast break. Got it.
They haven't just been cleaning the garage. They've been running an 11-store Foot Locker pilot program. This pilot is essentially a laboratory testing the future of the brand.
What are they testing exactly?
They're re-engineering how the stores are laid out, how the merchandise is presented, and how the customer interacts with the space. And management is highly encouraged by the data coming out of those 11 stores.
Okay.
The plan is to rapidly scale the learnings from this pilot across the entire Foot Locker fleet in 2026.
The report specifically notes they expect to deliver this inflection point beginning with the back-to-school season. So they have circled late summer as the exact moment they finally shift from playing defense and cleaning the garage to playing offense.
And that offense relies on a very specific, very delicate positioning. CEO Lauren Hobart stated that the combined company of DICs and Foot Locker is now perfectly positioned at the intersection of sport and culture.
Okay, here's where it gets really interesting. And honestly, this is the part of the strategy that is the hardest to pull off in the real world. I want to zero in on that phrase. Intersection of sport and culture. Because those two concepts require completely different corporate DNAs.
They really do.
Let's be real about what the traditional DICK sporting goods is. It is the ultimate utility and operational powerhouse. If you are a parent and you realize on a Tuesday night that your kid needs a youth baseball glove because practice starts on Wednesday, DICK has it.
Yep, they saved the day.
If you decide you want to take up kayaking or you need a treadmill or just basic soccer cleats, they execute perfectly. They are built on volume, ubiquity, and efficiency. That is the business of sport.
It's transactional reliability. You go there because you know they have what you need exactly when you need it.
But the business of culture, specifically global sneaker culture, that operates on the exact opposite principles.
100%.
Sneaker culture is driven by hype, deliberate scarcity, and exclusivity. When I highly anticipated limited edition sneaker drops, the entire point is that not everyone can get it.
Right, it's a status symbol.
People enter digital lotteries on the SNKRS app. They track secondary market prices on StockX. They line up outside boutiques. Selling that kind of hype requires a level of authenticity and cool factor that is incredibly fragile.
Very fragile.
So my question is, can a traditional big box retailer, one built on selling high volume family athletic gear, successfully nurture the cultural cachet required to resonate with the deeply fickle, highly specialized sneaker community? Can you merge massive utility with delicate hype without accidentally killing the hype?
It is arguably the most difficult balancing act in modern retail. What you are pointing out is the profound danger of brand dilution.
Yeah.
If Foot Locker, under this new ownership, suddenly starts feeling like a corporate extension of a suburban sporting goods store, it instantly loses the very cultural relevance that made it worth $2.5 billion in the first place.
Sneakerheads will abandon it overnight.
Exactly.
Oh.
But if you look closely at how Deep IKS already operates its other specialty concepts, there's a major clue to their strategy here. Think about Golf Galaxy or Public Lands.
Oh,
They don't try to make a Public Lands store feel like a DICK sporting goods store. They let Public Lands be highly authentic to the hardcore outdoor enthusiast.
so the strategy isn't to assimilate Foot Locker into the DICK's brand.
Not at the consumer level, no. The strategy is to give Foot Locker the back-end superpower of the DICK's corporate machine.
Like what?
Their massive supply chain efficiency, their deep data analytics, and their heavy real estate negotiating leverage. But, and this is key, while fiercely protecting the front-end brand so it stays immersed in street culture.
Right.
For you listening, this is what makes this report an incredible masterclass in M&A strategy. It's about building a holding company that merges an operational powerhouse with a cultural icon without cross-contaminating the flavors.
And we see that in the banner strategy. They're keeping the brands distinctly separate. You have Foot Locker and Kids Foot Locker for the mainstream sneaker buyer. You have Champ Sports. You have WSS targeting specific demographics. And critically, you have Atmos.
Yes, that is the linchpin for the culture side of the equation. Atmos is a highly respected premium sneaker and streetwear boutique brand. It is deeply embedded in the upper echelon of global sneaker culture.
Wow.
If DSX can provide Atmos with an ironclad, multi-billion-dollar balance sheet to handle the boring operational logistics, but allow the creative directors at Atmos to operate with total independence in the streetwear space, that is where the magic happens.
It's the best of both worlds.
Exactly.
Yeah.
Use the massive volume of the sporting goods side to subsidize the hyper-curated scarcity of the culture side.
Which brings the entire grand strategy into focus. You build an absolute fortress of a core business that generates $14.58 per share. You use that massive cash flow to confidently absorb a brutal $750 million garage cleanout of a struggling acquired competitor. You take the Jap net income hit on the chin.
Yep.
Then you use your operational expertise to scale a new optimized store model just in time for the crucial back-to-school season, all while carefully keeping your corporate fingerprints off the cultural cool factor of the sneaker boutiques.
It's a massive high-wire orchestration. And if they actually hit that 1.2 to 3.0% positive growth target for Foot Locker in 2026, it won't just be a successful earnings quarter.
What will it be?
It will be a validation of one of the most audacious retail strategies we have seen in a decade.
We have covered a lot of ground today. We started by looking at the undeniable financial strength of the standalone DICK's brand, growing comps by 4.5% and actively fighting off digital disruption by evolving their physical footprint with those massive experiential House of Sport locations.
Right.
Then we waded into the expensive, messy reality of the September acquisition, the $2.5 billion price tag, the 9.6 million shares issued, the terrifying 57% drop in Q4 Jap net income, and the painful physical reality of paying for the dumpster to clear out bad inventory.
The messy garage.
Exactly. And finally, we unpacked the ambitious 2026 roadmap, exploring the deep structural tension between the high-volume utility of sporting goods and the delicate, scarcity-driven hype of sneaker culture. So what does this all mean?
It forces us to look at the landscape of physical retail through a completely different lens. Next time you are walking through a massive outdoor shopping complex, and you see a House of Sport with a rock climbing wall in the window, and right across the street, you see an ultra-minimalist Atmos sneaker boutique with a line of kids waiting for a limited shoe drop. Realize you aren't just looking at two different stores.
Right.
You are looking at a multi-billion-dollar bet that utility and culture, mass volume and strict scarcity can be engineered and controlled by the exact same corporate machine. If DIEC proves that you can successfully be a mega aggregator of multiple intersecting lifestyles without losing authenticity, it changes the blueprint for every other retailer trying to survive the digital age.
It's a profound shift. They haven't just renovated the house, they're trying to own the entire neighborhood.
Perfectly said.
Something to think about next time you are lacing up a new pair of running shoes. Until next time, keep digging deep.